So hi everybody, thanks. Let me thank the organizers for two things. First, for inviting me to this very interesting event, and second, for letting me sit next to Claudio while Lars was presenting. And, but I regret that I couldn't sit next to Lars while Claudio was presenting. I think they would have, in both cases was a very instructive and entertaining experience. The usual disclaimers apply. These are my views, not the fund, the board, and so on. So I believe this is a very interesting paper. It's a nice summary of previous papers by the same authors, and a little bit unfair to me in the sense that Claudio yesterday asked me, did you read the other 4 papers? And I said, well, I know some of them, but I thought I was supposed to discuss just this one. Now, that said, it is a pleasure to discuss this kind of paper because it's very chatty, so to some extent it lets me pontificate on anything I want. And let me give you a brief summary. I think Claudio's presentation was very clear, but let me give you my 4 points. So I think that the paper makes the case for using monetary policy more actively and aggressively to preserve financial stability. And I think there are 4 points that they make, and they are all well taken. One, there is an increasingly volatile financial cycle which is not in sync or not always in sync with the real business cycle and with inflation. Second, this financial cycle can have long-term, medium-term real impact, including on the natural rate of interest, but especially on output and inflation. Third, they claim, and this is where I think the evidence is a little bit more shaky, that in part this is the result of the excessive focus of monetary frameworks on inflation targeting. And fourth, and I think this is something that we all have observed, they say, well, there is decreased sensitivity of inflation to the cycle and interest rates. For this reason, inflation is a poorer indicator of economic activity, and so we need to respond to other things, not just inflation. So this is a chart one of the charts that Claudio skipped in his presentation, essentially says, if you had a policy rule, say Taylor Rule 2.0, that incorporated financial conditions, you could do better. You could reduce output volatility over time, and essentially they do the equivalent of a cost-benefit analysis. This for the United States before and during the recent crisis, and you see that the cost, the red line is the log of real GDP, the cost in loss of GDP relative to the Taylor Rule before the crisis is vastly overwhelmed by the benefit of reducing the losses post-crisis. So I'm going to go through my comments mainly through charts. Rudy Dorbush always told us you should always have a chart in a presentation. I toyed with the idea of having only charts. I couldn't get there. But I'll try to go through charts. And essentially, I believe that from a theory standpoint, if you include frictions other than price rigidities, it is perfectly legitimate to argue that you should have a policy rule that is not just a Taylor rule. And there are plenty of papers. I cited here a couple, but there are probably 50 papers that do this. I think from a policy standpoint, however, you need a few conditions that need to be satisfied for this to make sense. First, you need to have large benefits from smoothing out the financial cycle. So essentially, this comes to how well the financial cycle predicts crisis and how permanent the losses during crisis are. The second, the policy rate has to be an effective tool to do so. And with this, I mean that you need to understand relatively well the leads and lags of the relationship between interest rate and the aggregates that determine the financial cycle. And these relationships have to be predictable and stable over time. Third, the cost from deviating from your traditional output inflation objectives have to be limited. And fourth, I would say, are there other tools available? So if we are on the desert island and we need to open the can of tomatoes, can we invent a can opener? Can we assume we have a can opener? So I think that for the first point, these are charts that we all know. This is to show that there is a gap between the financial cycle and output and inflation. This is Ireland, Spain, United States, United Kingdom. That on the top two charts, you see output gap and core inflation before the crisis. There's like a central banker's paradise, very small output gaps, very low inflation and stable. On the bottom, you see the credit to GDP and residential real estate prices just shooting up. And there is a clear evidence that this kind of booms, well, my time just jumped up 10 minutes. That's, okay, I can slow down. That's interesting. Okay.
That must be a mistake.
You know, it's a theory of relativity. If you go very, very fast, you know, time compresses. And so this is a chart showing on the horizontal axis the change in GDP between 07 and 09, so during the Great Recession. And on the vertical axis, you had a change in credit to GDP ratio before, in the 6 years before the crisis. The size of the bubbles is the level of leverage, so the level of credit to GDP in 2006. And you see there is a clear relationship. The countries that experience larger booms also experience larger losses post-crisis. This is at the state level in the United States. On the horizontal axis, I have house price appreciation. The size of the bubble is the change in mortgage credit before the crisis. And on the vertical axis, you have the increase in mortgage delinquency after the crisis. And you see the usual suspect, Arizona, Nevada, California, Florida are up there. And the states that didn't experience a bubble instead didn't have much of an increase in delinquency. One thing one of the reasons I put this chart up is also that I want to show you how heterogeneous things at the time just jump back down. It's just, you guys have to decide, otherwise I'm gonna go crazy. So it's how heterogeneous the experience of different states under the same monetary jurisdiction is. So if you believe that monetary policy is a big driver of this, you need to be able to explain why Hawaii and Arizona are so different from, I don't know, Ohio and Nebraska. This is a paper that Lars referred to where we look at the risk-taking channel, and there is some evidence that when the federal fund rate is very low, this is the panel on the right, banks tend to take more risk. So this is an internal rating measure that banks have on new loans, and they had to say how risky they are. It's a scale from 1 to 5. And you see that when the federal fund rate is lower, this tends to be higher. How economically meaningful this is up to debate. It's true that we don't find an enormous variation, but it is at the same time it's a discrete measure. And so it may be that the jump from 2.8 to 3.2 is actually meaningful from the point of view of risk-taking. What I think is more meaningful is the panel on the left, where we show, again, the federal fund rate against a measure of leverage. And leverage goes up quite significantly when the federal fund rate is lower. So we have evidence that is behind this risk-taking channel. Now, going to the next point of whether there is a predictable relationship between the policy rate and the financial cycle, here is the magic of PowerPoint. I overlapped a chart that I copied and pasted from Claudio's paper with the real federal fund rate for the United States. And you see that so the blue line is the financial cycle as measured by Claudio, and the green line is the real policy rate. Now, you see that in some cases, it seems to make sense. So especially around the crisis, you see a drop in the policy rate in the early 2000s, and that leads to an acceleration in the cycle. Then they tighten, the cycle crashes, and so that part makes sense. But there are many other parts of this chart where this relationship is much looser and is much more difficult to understand, say the mid-90s or even the 70s. And I think one important thing, and this is my banking IO corporate finance bias maybe, to notice from this chart is that there was essentially no financial cycle until the mid-80s. And then we know what happened. So there was massive deregulation. One of the lessons of the Great Depression that people forget is the FDIC, is intrusive regulation in the banking system, is a lot of safety net, is a lot of prudential measures that then starting with the late 70s, early 80s, started being eroded in the United States, and that's when we started seeing financial instability. But my point is that if you see how much the real policy rate jumps relative to relatively small movements of the financial cycle. This is to make the same point using the euro area as a lab case. So here I'm plotting the real 10-year sovereign bond rate. This was easier to find than the policy rate for Portugal, Spain, Italy, and Finland, and I'll show you the core countries later. So this is on the left-hand side, and on the right-hand side is the credit gap as measured by the BIS, which is to some extent a component of the financial cycle. And you see that these were the countries that experienced the largest drop in interest rate when the euro was introduced. And you see clearly a jump in credit in Portugal and Spain, but you don't see it in Italy. I mean, Finland, you can say, was recovering from a banking crisis, but Italy wasn't. And again, even in Portugal and Spain, two countries that are next to each other, when you keep going, you see that now under the euro, so in the mid-2000s, with the same monetary policy, they have very, very different behavior when it comes to the credit gap. And again, same story when you look at the core countries where the interest rate dropped much less. And this is Germany, the Netherlands, and Belgium. There is a little bit more correlation, but again, you see that there is something else going on. It's not just monetary policy. So monetary policy may have an effect on these things, but it's unclear how strong and how immediate it is and how predictable it is. So coming to the question of whether to lean or not to lean, this is from one of the paper that we put out on a cost-benefit analysis. This is a fund paper from 2015. Essentially, you had to decide between a loss in the short term in terms of your output growth, and possibly if you really care about your inflation target in itself, versus trying to deflate a potential bubble and so reduce the cost of a crisis in the future. And this gives you, obviously, the trade-off. Now, this is where I think I can look balanced and presidential and being a little bit in the middle between Lars and Claudio, although I think operationally we are closer to Lars, but we are still in an interior solution of the two. Is that our view is that in general, it's hard to make the case that you should lean against the wind with monetary policy. Now, I think that this relies on a number of assumptions, including playing with a standard, relatively linear model. And there are conditions in which we actually accept the idea of leaning. And these conditions are in particular are linked to a couple of things. First, you should be observing bubbles. I don't like the idea of saying, oh, low interest rates are bad. I think that's not grounded in any facts or empirical evidence. I think that maybe it's true that very low interest rates, when you also observe some bubbles and exuberance in important segments of financial markets, then they should raise a red flag. And the question then becomes, what do you want to use to deal with the red flag? I think if you are at a very low level of unemployment, very close to zero output gap or a positive output gap, then the conflict between what you need to do to deal with a real cycle and what you need to do to deal with the financial cycle is much smaller. And so that there is more room for leaning in that case. And there are at least a handful of countries at the moment that I could come up with where maybe inflation is very low, but they're very close to full employment. And so maybe the cost of leaning is not that high. But otherwise, in general, we are closer to Lars's answer. And again, the issue here is, do you have something else that you can use to deal with these problems? And let me get right there. So one final point on the role of financial variables. This is potential output as reported by our country desks to the WIO. The red line is the April 2015 WIO. And the blue line was in real time. So every year, these guys have to submit these numbers. And you can see that for the United States, there is a massive revision vis-a-vis what they thought was going on before the crisis. So people thought, oh, the output gap is small negative, it really was a small positive. If you do it with Greece and Spain, the difference is an order of magnitude larger. And it is clearly correlated, this error, if you want, this revision, with both credit and house prices. So what we did was to try to predict systematically revisions in the view of our desks of the output gap. So we're going back 30 years and projecting the output gap 3 years ahead and try to explain the revisions. And using just credit growth and house price growth, we could explain about a third of the revision. So there is maybe this is a way we kicked the financial cycle out of the door in monetary policy. We bring it back through the window by saying, well, it's not really that you care about the financial cycle per se, but it may help you determine where the output gap is, and so you may want to use it that way. And if you do this and you correct your view of overheating before the crisis, you see that I have the economic gap on the, so they say the Taylor rule gap on the vertical axis and the financial gap on the horizontal one, and you see that before the crisis, if you had used financial variables to correct your view of the output gap, most advanced economies would have been in a region where you wanted to tighten anyway. So there would have been a conflict between the two objectives. My final point, and again, this is my banking bias, and this is a paper that also Lars referred to. So these are bank NPLs in crisis, in historical banking crisis. The red ones are OECD, the blue ones are emerging markets and developing countries. And this is the point that Lars made. If you had about 20% capital in banks, you would avoid imposing losses on creditors in about 80% of this crisis. It is true that for emerging markets, the numbers are much bigger, but if you scale them instead of bank assets, you scale the losses by GDP, the crisis become very similar because emerging markets have much smaller banking systems. So the same level of capital would limit the losses to about 3% of GDP. So from a prudential point of view, it looks worse, but from a macro point of view, it looks very, very similar. So I have 15 seconds, so thank you very much.